Welcome back to Capital Code. Today we will be going over the differences in hedging and hedge funds. They are a common misconception to get confused, because although these terms may seem nearly identical at first glance, they are quite distinct concepts. Let's properly define each one and briefly discuss how each is used in the market. Starting off, the hedge fund's key characteristics. Hedge funds are private, often only used by the top 1% of the population, who seek to maximize profit at any cost. A hedge fund is a pool of money. Pooling is a strategy in finance that means to combine resources such as assets, equipment, effort, etc. to gain an advantage. An example of this would be a bank, because many people all pool their resources into this one area. A hedge fund is an investment fund. Investment funds are a method of investing by sharing money alongside other investors and reaping the benefits of working as part of a group. Examples of this would include things like mutual funds, exchange-traded funds, etc. This is a key concept and will be discussed in more detail in a further video. Hedge funds hold liquid assets. Liquid assets are essentially the speed at which one can purchase or sell a specific asset without causing a dramatic change in the price of the asset. Hedge funds use complex risk management and trading techniques to maximize the output. Such techniques include short selling, leveraging, and derivative instruments, making hedge funds a high-risk, high-reward investment. In the United States, it is mandatory that these funds are managed by an institutional investor or accredited investor, which tend to be the millionaire investors. That concludes a brief summary of what hedge funds are. Next, we'll cover hedging, which again, despite the similar name, is an entirely different animal. It focuses on offsetting risk, not leaping headfirst into it. Hedging. A hedge is an investment position intended to offset potential losses in another related investment, where an investment position is just the binding factor of the investor, like in a contract with a short and long party, as discussed in the last video. It can be constructed by various financial instruments such as derivatives, funds, etc. An example of this would be, imagine an airline knows that in about 6 months it will need to buy 10 million barrels of jet fuel. Jet fuel prices are closely tied to oil prices, which can be highly unpredictable. If oil prices spike, the airline's costs could explode and wreck profits. To protect itself, the airline entered a future contract today to buy at $80 per barrel 6 months from now. There are two things that can happen now. The first possibility is that, let's say 6 months later, oil prices jump to $110 per barrel. Without hedging, the airline would have to buy the oil at $110, which is a huge unexpected expense for the company. With hedging, the airline buys oil at the pre-agreed price of $80. It avoids the price spike, saving $30 per barrel. This is the safest option for the company, because no matter what, they won't pay more than what they expect to pay. The second option is 6 months later, the oil drops to $60 per barrel. Without hedging, the airline could buy cheaper fuel and save money. With hedging, the airline is locked into paying $80, missing out on lower prices. Even though this might seem like the worst outcome, it's essential to understand that the profit wasn't the goal of the airline company. The goal was to get a stable amount of oil for a certain price that they know, so they can effectively set out jets. This is also a prominent feature of a forward contract, or derivatives. Because they know they profit at $80 per barrel, they don't mind losing out on some possible money with possibly cheaper barrels, because they know they aren't as much at risk of losing money. While they could have made more, this is a much safer and guaranteed profit. In conclusion, we can clearly see that hedge funds and hedging are quite distinct. In summary, hedging is used in order to reduce risk and gain a stable output of a certain resource, and hedge funds are used in order to maximize profits by letting very wealthy professionals engage in risky strategies like short selling, leveraging, and derivative contracts.